Hey Bowtie Nation, Joseph Hogue here with Let's Talk Money, and it is time to start thinking about your 2021 investing plan. I know it sounds early with still 2 months left in the year, uncertainty around the elections, and the market down recently on those stimulus talks, but right now, right here is where your best opportunity is for finding those stocks to buy that are going to lead to market-busting returns next year. In fact, in this video, I'm rolling out our 2021 Bowtie Nation portfolio, a stock portfolio I'll be tracking all year to beat the market, and I'm adding the first 5 stocks today. I'm also going to reveal the biggest disconnect in the market right now and how I'm using it to position in these stocks for the next year and beyond. We'll be tracking the portfolio on StockCard.io, a great research tool that I've been using lately that makes it easy to find stocks to buy. And one of my favorite features on StockCard is the ability to publish my portfolio here in the portfolio store. Follow the portfolio on the site and you'll get advance notice whenever I buy or sell a stock in it, even before a video comes out. Now it's going to be free to follow that portfolio, but as a bonus, I've negotiated a special deal for all you out there in the Bowtie Nation. Sign up using the promo code BowtieNation, that's all one word in lowercase, and you'll get an extra 10% off beyond the 2-week free trial and the other discounts on the platform. So look for that link to the 2021 portfolio in the video description below and the promo code BowtieNation. Now I want to get to that market disconnect and explain why I think this could be the biggest opportunity for 2021 in stocks. But as always, you know I gotta send a shout out to all you out there in the nation. Thank you for taking a part of your day to be here. If you're not part of that community yet, just tap that little subscribe button. It's free and you'll never miss an episode. Nation, one thing we talked about in last week's live stream is investing around a narrative. And now a narrative is just how the market is taking all the news, all the information available to build a story around stock prices. Then your job as an investor is to find where you believe that narrative is wrong, whether it's in the entire market or around a specific stock. And this is really the only way to beat the market, and it's where I spent the majority of my time as an analyst, investing in what the market doesn't see yet. It's the old saying, right? Be fearful when others are greedy, and greedy when others are fearful. And to find that market narrative, the story that investors are building into stocks, I like to start with looking at the returns to the individual sectors. So here we see the 2020 returns on each of the 11 stock sectors plus the S&P 500 market index. And overall, the broader market has bounced back spectacularly for an 8% return this year, which is really amazing in itself. I mean, if you would have said in March, when the market was down 35% from its peak, that we could be at an 8% gain by October, even as 900,000 people still are filing new unemployment claims each week, I would have said you were batshit crazy, but here we are. But then taking that market gain, and we'll see in some of these sectors that the market is really saying that the economy isn't that bad off, that the market is expecting a continuation to the economic recovery. Now, of course, a lot of this is on the back of historic levels of government help, from that $3 trillion plus CARES Act in March to the $4 trillion money printing program by the Federal Reserve. And in fact, part of that market narrative is just telling us that it expects more stimulus in the future, because look at these top 3 sectors. Communication services, consumer discretionary, and tech stocks, that's returns of 14% to 33% on the year. Now, while the communication services and the tech stocks have both benefited from the lockdown, there is no way in hell the consumer discretionary stocks should be doing that well if the market doesn't see rosy days ahead for the economy. And Nation, this is where I see that disconnect that we can take advantage of for our 2021 portfolio. Now let's look at those 2 worst performing sectors, so energy and financials. Stocks in the financial sector, so banks, insurance companies, and services are down 20% this year. And that drop of 49% in the shares of energy companies is unprecedented. Now, the loss on stocks in the financial sectors is from 2 factors, but both related to one theme. First is the fact that banks have been moving billions of dollars from their earnings to a special account called loan loss provisions. Now, this is where the banks hold cash reserves in case loan defaults get really bad in a recession. And here, just the top 4 banks have moved $20 billion into this account into the first half of the year. That money is taken off earnings, so the profits of these bank stocks have been obliterated as they build up these reserves. Now, another factor in the financials is that yield curve, and this is the interest rate for U.S. Treasury bonds of different length from 1 month all the way up to 30 years. And it's off these rates that all other interest rates are set. And you can see here that curve is really flat, so the interest rate of 1.5% for the 30-year treasuries really isn't that much higher from the 6-month or the 2-year rate. Now it looks steeper here only because how the graph is set up, but that's only a difference of 1.3% from that 3-year to the 30-year treasury rate. That makes it really difficult, almost impossible for banks to make any money because they're paying those short-term rates on deposits and then collecting the long-term rates on loans, but there just isn't much of a difference between the two. Now, banks make money on the difference in that interest rates, and it just isn't there right now. Let's look at the energy sector, then I'll explain how this is a huge disconnect in the market and show you those 5 stocks I'm buying. The problem in energy stocks, of course, is that apocalyptic drop in the demand for gasoline and jet fuel. Air travel dropped to 0 and is still down by more than half compared to last year. Energy demand for industrial use and drivers is also way down and just doesn't look like it's going to be up anytime soon. While supply has come down a little bit, oil companies have pulled back on their production. It just hasn't come down fast enough. Now you see here a chart by the U.S. Energy Information Administration. With the blue line is going to be global oil and gas production. Then the brown line is that consumption or the demand for these energy products. Now that demand is expected to plunge 8.5% this year. That's the equivalent of the world needing 8.6 million fewer barrels of oil per day. Supply, for its part, then, is expected to fall just 6% this year. So here, the EIA expects global oil companies to reduce their production by just 6.1 million barrels of oil per day. And then that's 2.5 million barrels a day that energy companies are pumping out that isn't being used, isn't being demanded by consumers, and oil prices have just cratered because of it. Now, do you start to see this disconnect, though? And for patient investors, I think this is where you can really make some money. So here, on the one hand, the market is telling us that the economy really isn't in that bad of shape. If we're expecting more stimulus eventually, and all these other sectors like consumer discretionary are doing well, then energy and financials should not be in this much trouble. For example, if we do get more government spending, pushing more money into the system, then we're bound to see more consumer spending, more inflation, and more demand for loans. And for stocks in the financial sector, that's going to do at least 2 things. First, we won't see nearly the amount of loan defaults as the banks have been planning on with that loan loss provisions account. Some of that $20 billion plus that has been moved into those accounts can be then brought back to profits to surprise on the upside. Second, though, is all that economic activity and the inflation could mean a surge in those long-term interest rates. Now, the Fed has already told us, it's already committed that it won't be raising short-term rates for years. So if we do get those longer-term rates to move higher, that's going to mean booming profits for those banks. And then on the energy side, how do you get a growing economy without higher oil demand and higher prices? It just doesn't happen. Going back to that graphic, the EIA expects oil demand to jump by 6.25 million barrels per day next year, while producers are only expected to increase supply by 4.25 million barrels. That would put us into a deficit and push those prices right back up. So that's the market narrative and the disconnect that we're looking at. If you think the market is right and the economy is recovering, then these 2 sectors should not be doing as bad as they are, and they could be the turnaround stories of 2021. Now, bank earnings were disappointing last week, but I like shares of Citigroup, ticker C, for that rebound in financials. Now, I'm not saying things can't get worse for banks or that the shares are going to explode higher immediately, but it's hard to argue with the valuation on this stock. Here is a global leader in financial services trading for half its book value and paying a 4.7% dividend yield. Even if it takes 3 years for banking to rebound and the shares to recover that 2019 high, that would still be an annualized 27% return. Citigroup beat third quarter earnings estimates by 50% last week, and management just has a history of destroying those expectations. I think that $5.73 per share they're expected to report all next year, already at 45% on this year's profits, I think that can easily become like $6.80 in earnings and makes this one of the best stocks to buy right now. Analyst price targets range from $45 a share on the low end to as high as $102 each over the next year, and a potential 47% return to that average target. Our first energy stock to buy here is Diamondback Energy, ticker FANG, one that I highlighted in our video last week as well. Diamondback has been aggressively cutting its drilling rings to bring down those costs and protect cash flow. Capital spending is down 35% from its original 2020 plan, and operating costs are looking really good. Management reported cash operating costs of just $8.16 per barrel in the second quarter, which is already among the lowest in the industry. Those costs came down 20% in the second quarter alone and should help to beat this quarter as well. Those lower costs have helped management commit to its $1.50 per share dividend for a 5% yield, and the company is one of the best positioned for that eventual rebound in oil prices. Diamondback is also one of the few producers to remain profitable throughout all this and beat expectations by an outstanding 800% last quarter. The company reported a profit of 15 cents per share versus just a 2 cents per share analyst estimate. Now, earnings are expected 31% higher next year to 3.25 per share and could just continue to grow from there. Analyst targets range from $44 on the low end to as high as $65 per share over the next year. Now that doesn't mean it can't come in under that range, but that's a huge vote of confidence for the shares. Our next pick is another energy producer, $3.5 billion Devon Energy, ticker DVN. And now for those two names, Diamondback and Devon, it's really that blood in the streets pricing, right? You've got great companies with very strong financials, certainly strong enough to survive until the price of oil recovers, both trading at these bargain basement prices. So again, if you can have the patience to wait around maybe a year, maybe even 2 years at the most, I think you can get high double-digit returns on these plus that solid dividend yield while you wait. Devon has nearly $1.5 billion in cash sitting on the balance sheet, more than twice its current liabilities, so just a sound financial position to ride this all out. Despite dropping into negative earnings in the last quarter, the company still beat that market estimate by 30% and is expected to return to profitability by the first quarter of next year. Our shares traded for 25 times on that PE basis before the February crash and should get back to that level of earnings in 2022. Analyst targets are for a low of $13 a share to as high as $20 each, which would be a potential 114% return on that current price. That gives us our energy and financials exposure to the group, and I'm going to be adding more stocks in the future, so make sure you're following the portfolio on StockCard. I also want to add 2 more stocks here that I think could do really well over the next year. Even with this year's weakness, shares of Uber are up 21% since recommending it last December, and I'm adding Lyft, ticker LYFT, to our portfolio for a lot of the same reasons. I think that trend to on-demand transportation comes back strong next year and helps push these shares higher. Before the pandemic, Lyft booked annual sales growth of over 100% over the last 3 years. There's plenty of upside left for both Uber and Lyft here, but the fundamentals are pushing me in favor of that smaller company right now. Lyft is just in a much stronger financial position with a stronger balance sheet. They've got $2.8 billion in cash versus just $1 billion in debt, so a net cash positive balance sheet. Now compare that to Uber, which is cash negative position with $9.6 billion in debt against $7.8 billion in balance sheet cash. Now that's not saying that Uber is in any existential danger, just that I like the financial strength of Lyft better right now. Now shares of Lyft are also much more attractively priced at just 2.5 times sales, almost half the cost of shares of Uber with a stock price of 4.7 times its annual sales. Lyft did miss sales estimates for the second quarter, but they were able to beat on the bottom line earnings, which actually tells me that management's making those hard decisions necessary to cut costs. Demand picked up meaningfully through June, and I think the worst is baked into these shares. Revenue is expected back up to $1 billion a quarter by the third quarter of next year, and management still believes it can reach profitability by Q4 of 2021, which would be a big sentiment boost for these shares. Analysts have price targets for Lyft from $30 a share on the low end to as high as $66 each over the next year, and an average estimate for a 64% upside from here. Those of you in the nation are probably tired of hearing me talk about CVS Health, ticker CVS, but I really like this one as a rebound play. CVS is uniquely positioned in healthcare with over 10,000 stores, its insurance and pharmacy benefits segments, and the Minute Clinic offering. This allows it to control just about every step of that healthcare distribution chain from consultation to pharmacy and payment. The company is also rolling out its Health Hub concept next year with 1,500 stores for that quick health screening, and all of this is just really building into that idea of bringing people into the system and then keeping them there every step of the way. CVS beat earnings expectations last quarter by 37% and is expected to post $6.40 per share earnings over the next year. That's 21% lower than last year on that weakness in its retail sales, but with the company's history of beating estimates by a wide margin, I think they could match last year's earnings. These shares are historically cheap at under 10 times on that price to earnings basis, and the stock pays a solid 3.4% dividend yield. Analysts have price targets for $61 on the low end to as high as $104 each over the next year, so pretty much consensus for positive returns going forward. Look for that link and the promo code in the video description below and follow our 2021 portfolio on StockCard. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.